Massive stock market sell-off comes as investors now turn to the March jobs report tomorrow. So how should investors position themselves now? Let's ask Cboe's Mandy. She joins us here on set. Mandy, great to have you with us. In terms of today, we saw a big volatility spike. We closed at around 30 or so. But, on the 12:30 call, these guys were saying that they expected it to be much higher.
Exactly. So as big of an increase in the VIX as we saw today, we would have expected a much bigger increase given the fact that S&P sold off almost 5%, right? If you recall, last August when we had that almost 5% pre-market sell-off, VIX was 65. Wow. So in terms of what's different this time, I think the fact that tariffs, while what was announced yesterday was larger than expected, it was very much an anticipated risk for the market. It wasn't a true shock, right? It wasn't a black swan event. And typically what really produces the kind of type of volatility shocks, we saw last summer was a true black swan event. And that's not what we saw yesterday. Or today.
In terms of volatility in the other asset classes like yields, for instance, was that more in line with what you were expecting or still muted?
No, we did see volatility increase across asset classes. In terms of what stands out on a cross-asset basis, I would say right now, credit volatility to us seems fairly contained given this rising concern of a recession, credit spreads being still fairly tight on a historical basis. In the rates market, in the bond market, what's interesting is that for all the talk about stagflation, the possibility of much higher inflation, the bond market is solely focused on the downside risk to growth. There's almost nothing being priced in for the inflation. So all the positioning is for rates to go lower from here. Very different from what we saw in 2022 when it was the other way around.
Right.
Mandy, we spent a lot of time talking about the VIX at the index level. Can you kind of tell us what you're seeing under the hood at the individual single stock level and whether that's telling us a different picture or a different story about investor sentiment around fear?
Yes, and I say one of the reasons why the VIX was probably more contained today was that investor focus was actually really the idiosyncratic, the stocks selection side. People were looking for the winners and losers of tariff policy. So what we saw actually was a fair amount of dispersion, right? We had certain sectors, staples, utilities actually up on the day, and even within sectors, I think you guys were talking about in the retail, Dollar General versus Dollar Tree, exactly. There was quite a bit of dispersion there. So that, to me, suggests that people are still looking at from an earnings from a fundamental perspective and not from a macro perspective. So if there were more fears around recession, more macro fears, you would start to see higher levels of correlation, and that would kind of then you would expect to see higher levels of VIX. So I would say right now, equity investors still focused in terms of stock selection, sector selection, picking out the winners and losers. Could that change? Certainly, and if it did, we would expect to see higher levels of volatility.
So, Mandy, if the VIX is only good for a black swan event or things of that nature, I don't want to put words in your mouth, but that's how you framed it, where you see these spikes in volatility. What should the people watching the show, what should us as traders, when Bono would ask you about individual names, is there a certain aspect or a certain metric that we can look at as traders that will give us a day-to-day volatility picture versus the black swan events?
Yes, absolutely. So to be clear, so VIX, when I say good for black swan, I mean, significant VIX spikes like to 60, 50, 60 type of levels, typically you would get, it's on the back of a black swan event. But in terms of what other volatility measures you can look at, we actually released a VIX for single stocks. The ticker is VIX EQ. It's looking at the top 80, 90 stocks in the S&P. That gives you a good measure of kind of average single stock volatility in the market. So if you want to look at the stock side, we also have, measures across asset classes, VIX TLT, which looks at bond market volatility, VIX IG, which is credit volatility. So we do have, a variety of measures for across asset classes as well as within the equity market.